Today, we will tell you about how to withdraw money from retirement account. Let's have a look at the details. Technically, you can withdraw money from your retirement plans at any time. However, these accounts were created to provide you with income after you're no longer working, and withdrawing from them early defeats that purpose. The tax code includes a number of provisions that provide incentives and tax breaks for people who save for retirement, but these breaks can come back to haunt you if you want to withdraw retirement money early. If your reasons for withdrawing funds early don't fall into one of a few limited exceptions, you may have to pay income taxes on the funds you withdrew as well as an additional 10% tax. The first method is withdrawing without a penalty. Check the types of plans you have. While there are limited exceptions that enable you to withdraw retirement funds early without any tax penalty, many of these exceptions only apply to money held in particular types of accounts. The type of plan you have also determined the earliest age at which you can withdraw retirement money without penalty, and whether you must first leave your job. Evaluate your reason for needing to withdraw early. In some specific situations, such as disability or extensive medical bills, you can withdraw retirement money early without having to pay any additional taxes apart from basic income tax. For example, if you have medical expenses that exceed 7.5% of your adjusted gross income, you can withdraw retirement money to pay those expenses. Consider your age. If you are over 59.5 years of age, you typically can withdraw money from your retirement accounts without penalty even if you're still working. However, you also may have the option of withdrawing from your retirement accounts at any age, if you can structure substantially equal periodic payments. If you are between the ages of 55 and 59.5, you can withdraw your money early without penalty if you've left your job. Gather documentation. If you've determined that one of the exceptions applies and you're eligible to withdraw retirement money early without penalty, you will need documentation to present to your financial advisor or plan administrator to prove that your reason for needing the money falls into that exception. Contact your financial advisor. Once you've made your final decision on the account from which you want to withdraw money, your financial advisor or plan administrator can assist you in filling out the documents you'll need to set your plan in motion and get your money. The second method is withdrawing with a penalty. Calculate how much money you need. Because penalties and taxes typically are a percentage of the total you've withdrawn, figure out exactly how much you need to withdraw to accomplish your objective, and don't take out more than that. Contact your financial advisor. Your financial advisor or plan administrator will be able to help you with the specifics of completing the necessary forms and withdrawing the money from your retirement account. Your advisor may be able to help you explore other options that will enable you to meet the same goals without withdrawing money from your retirement account and having to pay stiff penalties. Determine how much the tax will be. So that you can plan ahead, you should calculate the taxes you will owe on your withdrawal and understand how that will affect your budgeting for the year ahead. Report the money on your taxes. You must report any money you withdrew from your retirement plan on IRS Form 5329 and file that form with your tax return for the year you withdrew your funds. In addition to filling out and filing Form 5329, you also must report the additional tax on the appropriate line of your Form 1040. The third method is taking out a loan. Explore the options available. Whether you can borrow the funds in your retirement account depends on the bank or investment company that administers the account, and the type of account it is. In some situations, how old your account is and how much money you have in the account may also be a factor. Review the terms for your retirement account's bank or investment company, and compare that to the costs of a traditional loan to see whether this is truly a good option for you. Calculate what portion of your retirement funds you need. Generally, you won't be able to borrow more than 50% of the total funds in any single retirement account, and you may not be able to borrow from more than one account at the same time. There may be an option on the loan application to simply request a loan for the maximum amount available. Keep in mind that if you calculate the maximum incorrectly and request a loan greater than the maximum available as a result, this may result in delays or denial of your application. Complete your application. Although most investment companies typically don't run a credit check, expect to fill out a paper application detailing the amount of money you want to borrow and the term of the loan. Keep in mind that you are responsible for determining how much you can pay back realistically and setting the term of your loan accordingly. This requires careful budgeting to make sure you'll be able to make your payments according to the schedule you create. Receive your funds. The investment company will process your application and send you a check. If your application is approved using the method you indicated on your application, you can expect to receive your check within 7 business days from the date your application is approved. Make your loan payments on time. You will have to pay the money you've borrowed back with interest at regular intervals, typically quarterly or as directed by your plan. Your payments will be credited back into your retirement account. Thanks for watching our video. Please don't forget to subscribe.